Now I'm recording it. I want to share a concept with you. As a matter of fact, this is a kind of, and I will try my best not to use any slide, but I want to use a concept with you and show everything with the help of the one spreadsheet. So one spreadsheet is basically including most of the concepts and the calculation, and it's pretty simple. Hopefully, yes. Hendrika, she talked to you. And she mentioned that she calculated a concept, she measured a concept called Jensen's alpha. Jensen's alpha is a very comprehensive and very important tool when you want to compare any company's performance with itself. But we'll go in a phased way, right? Now you see here, I have done this task in the context of Kone. You know Kone? That is a very famous company. And here, all you need is first two inputs. So what I get is, I get Kone's closing price. Whenever you want to compare the stock market performance of a company, always take the company's daily stock price, but closing price. Closing means by the end of the day, right? Like today is 1st of November, the market starts at 9 o'clock. Now, I don't want the price in the morning. I want when the market closes around 4:30, that price is more important, okay? Stock market price. You can see here, we took the data right from 2nd of May, rather till 2nd of May. And we started from 3rd of April 2012. So it's a very comprehensive data. And if you remember, once upon a time in discussion forum, I shared with you that I have the historic market data of almost all the companies in Finland. Maybe for this company, I have till 2018, but for most of the companies, I have 2017 till 2017. So if you want to take that data for your research in finance, you just have to add one more year, and that's it. We have all the data sets. Now, the point. This is the closing price of the company. When I say price, it means the stock price, not the product price, but the stock price. Remember, the absolute price doesn't make a company's performance good or bad. Never judge a company's market performance based on its price. Always judge on the basis of dash. Always judge the performance on the basis of return. If your company's share is selling at 1,000 euros, and the next day the price is 1,001, and another company is B, the price is 10, next day it goes to 11. The absolute increase, the price is 1 euro here, 1 euro here, but here the percentage increase is 0.0001 maybe, but here the absolute increase is 10%. All right, so we judge the performance not on the face value of the stock price, but based on the return. All right, and here you can see the market, the return. Yeah, I hope you can see the formula. The formula is always the current price minus the previous price divided by the previous price. And if the dates are not matching exactly, it means it was a Friday. So the next Saturday is closed, Sunday is closed. And sometimes there can be more than 3 gap days, more than 2 gap days, because there could be some holiday, day off. Or sometimes there's no public holiday, there's no day off, but the market, because of some technical reason, is closed. Usually, there are 250 working days in the stock exchange. Normally, as a rule of thumb, 250 working days are a rule of thumb kind of thing. All right, so what I do here, I get 1 day stock price, and just as an Excel function, imagine you are doing it first time, so you will be having only one cell here because you calculate only one. Once you have this kind of cross, if you click it, it will go all the way down. You don't have to drag it. You don't have to drag it. Just click this cross, it goes all the way down. The same way, we have the index price. Like Kone is among the top, Finnish companies. So I got this data from OMX Helsinki Nasdaq.com. All right. So here there is an index value, the market value. Once again, the value absolute doesn't make any sense. But what makes sense is the market return. Market return is the one which makes sense, right? And once you have it, once you have one number, find this point, this cross, click it 2 times, it will go all the way down. I have 1,524 observations. And how many years I have? I have 6 years. So basically it's 254. So the 254 trading days during average for the last 6 years. Enrica talk about risk. Risks are 2 types. One type of risk is called market risk. We also call market risk as the systematic risk. Systematic risk are those risks which come from the market, from outside. You can be a fantastic company, but if you are a fantastic company but suffering from the global recession or inflation or fiscal deficit or unemployment or even the political crisis, you will be in trouble for no fault of yours. The risk which come from outside is called systematic risk. But you can be a company in a very normal, peaceful environment. Everything is good, but you can be a bad company governed by the bad people. What happens? Whereas every other company is making success, you can be in trouble. That risk is called unsystematic risk. Unsystematic or internal risk, which come from within the company. Right? Make sense? Systematic risk is the external risk or the market risk. We also call it business risk and sometimes macroeconomic risk. Whereas the unsystematic risk is called internal risk or the firm risk or the specific risk or the micro risk. Okay. This is why recording is important, because I'm using all these phrases so you can recap if the need be. The question is that we are studying finance and I'm using only these phrases, systematic risk or unsystematic risk. Is there any way to quantify these risks? Yes, we have. Beta measures the systematic risk. Beta is a measure of systematic risk. Basically, what beta is measuring, if I take Kone return on y-axis and OMX Nordic on x-axis, beta is the slope. You know the slope of the straight line? You must have done in mathematics in high school. We have a slope. Slope means how much change in y occurs if this is y-axis and this is x-axis because of change in x. So the slope is equal to change, delta is change, symbol divided by delta x means change in x. Okay, right? So y depends on x. So the Kone stock return depend upon the market return. And if you look at this formula, I can clear it. Even Excel read beta as slope. See, I write slope function. slope of the company stock return data separated with a semicolon with the market return data. Because the argument is that it is the company stock return which depends upon the market return. It's not the market return depending upon Kone return. You get my point? So the company return is a function of the market return. So therefore, we use this symbol slope, and we always take the first data. You can see C2 to C1524. You only need once. I wonder why this mistake is not picked up, but it should be. Anyways, so you need to write only once, yeah? And C2 to C1524 is the Kone return. You can see the C column. And E2 to E1524 is the OMX Helsinki return, which is the market return. And when you click it, it shows beta 0.90. Beta is 0.9 or approximately 91, I can say. Now, what is the interpretation of beta is equal to 0.91? It shows that this 0.91 shows that if all the companies in Helsinki Stock Exchange go up by 1%, Kone's stock return will go up by 0.91%. However, if all the companies' return goes down by 1%, Kone stock return would go down by 0.91. Can I ask you, based on this statistic, is Kone is good for risk-averse investors, risk-neutral investors, or risk-lover investors? Remember, we have three types of investors. Risk-neutral, they take some calculated risk. They are never shying away from risk unless the risk is not too big. Risk haters hate all types of risk. They are very safe players. And the risk lovers go for the kill. They are catching, they are hunting the stocks with very, very high beta. Yesterday, the day before yesterday, I was discussing in case of the betas about some companies, and I found that there is a company called, I think it's a Scottish Energy. It provides electricity to the households. The beta was 0.17. And then we found the Wimpey, which makes very expensive holiday homes in Bahamas, in Dubai, in all those exotic destinations, and their customers are all the Hollywood stars and the rich football players and the tennis players. And guess what? The beta was 3.4. No wonder. I was not surprised, because for the utilities price don't change much. Whereas the gold, diamond, the exotic houses, the prices fluctuate very rapidly, and it can go in any directions. All right. Yeah. Now, the point here is that, is Kone good for risk lovers, risk averse, or risk neutrals? Neutrals. As a rule of thumb, any beta which is less than 0.8 is for the risk averse investors. Those who just don't like risk, want to be the benefit. Look, they're very selfish people. They want to be the beneficiary of the stock market, but at the same time, they want to be on the safe side. And risk haters are very clear. I mean, the risk lovers are very clear. They want to pick up any company whose beta is more than 1. Like in case of Henrika, she found that during the time of crisis, Nordea's beta was 1.21 or something. Yeah. All right. And then we have a category of investors who are risk neutral, who are very clever people. They can be on the either side. So their beta is generally varying between 0.8 to less than 1. So, or 1. You're right. risk neutral investors. So if you are a risk neutral investor, Kone is a good choice for you based on the last 6 years data. We have pretty big database now. Now what happened? This is the systematic risk. Beta is a systematic risk. So you are comparing this company with, now return is one, risk is one side. The next thing you want to find out is return. Okay. Now what I do here, Kone's daily return. Kone's daily return. Can somebody see what I've done here? Average. Because this is for 6 years, right? So what I get 6 years daily stock return of Kone. Don't forget, it's daily stock return. Even though it's average of 6 years, but the data is given daily, right? But to make a good comparison, it's not a bad idea to make the annual stock return. So if you have a daily stock return, you can make it annual stock return. Like for example, if I say that, hey, you have earned 20, you get a bonus of 20 euros a month. How many euros you get, how much bonus you get after 8 months? You say 20 times 8. You do some multiplication, yeah? So what I do here, from the daily return, we make an annualized return. How? The daily return plus 1, formula 950. Why 250? Why 250? Because we have 250 working days in the stock market, right? Minus 1, it's a formula, standard formula, is exponential, right, to the power of, and what we get is 14.62. It means that if you are an investor, having invested in Kone for 6 years, then on an average, you get 14.62% return. Remember, this is covering 2012 to 2018, right? 6 years. So one thing is clear that this is not too much affected by, so based on 14.62, I can say that recession is over. I mean, who will get 14.62% return during recession? All right, so this is a very good performance, I would say. 14.62% a year, believe me, is a Hoover performance. Really good, really good. Make sense? Now, can I ask you one thing? If this was not stock market, and I have borrowed, you know, we borrow money from the credit card or make a credit payment. Let's say I make it worse. I use credit card to take money out from the ATM, not debit, but the credit card. So I get the credit money. Now, after 1 week, I get a statement that, hey, this is what you borrowed. This is what you have to pay. And that also includes interest. And I want to find out what is the annual interest of the credit card. Would I use 250 on top of it? Will I be using 250? Okay. Because you would say that you have taught us at 250 as a trading day, so let's use 250. No, you will be using 365 because when bank is charging interest on you, they don't give you leeway if it's a holiday, or a Sunday, or a weekend. So be very careful. It's a matter of, again, common sense. Why should you be getting higher return for Saturday and Sundays when the market is closed? So that is why we are using 250 for the stock price. But if you have to annualize daily or weekly interest rate for a year, then you'll be using 365. If it is daily, 365. If it is weekly, use 52. And if it is monthly, use 12. Make sense? So there is a reason of it. The same way, I calculate the average The average what? The average market return. And then the same way, we find out the annual market return. Make sense? When I compare the company's actual performance, which is this, vis-a-vis the market performance, I think Kone has beaten the market. I think Kone has beaten the market, hasn't? Because the market is giving you 12% something, 12.8% a year. Kone is giving you 14.6% a year. So definitely Kone is performed better than the rest of the market. Great, good job. But here is the catch. Here is a catch. If you remember, I gave you example of when Henrika was here, and I said that, you know what, you appear in the exam, and I expect that you will be getting 5, but you get 4. Make sense? See what? When I compare you with the rest of the crowd, in other words, when I compare Kone with the rest of the companies, Kone has outperformed. So basically, there is a student X in the class. The student X has outperformed everybody else. But that is not the ultimate success criteria of X student. The student has got 75 marks. Nobody else has got 75 marks. So he or she is first, no doubt. But guess what? I was expecting him or her to score 95. So even though when I compare the student with the rest of the students, has outperformed. But when I compare this student with his theoretical expected marks, the student has underperformed. Does it make sense? That's what we do with the help of Jensen's alpha. Jensen's alpha gives us an idea that what should I expect from you? Have you beaten the expectations attached to you only? No market, nothing. Your comparison with yourself. So now I want to compare what was expected from Kone and how much it delivered. Definitely Kone has beaten the market, but I don't want to compare. But that's a good thing. But that's the next stage of comparison is that I want to compare Kone with Kone. In that case, we use a model called which is equal to the actual performance minus expected performance. Expected performance or theoretical performance or hypothetical performance, whatever word you want. And this expected performance comes from a formula or from a theory called CAPM. Have you heard about CAPM? All of you? Hope you have. This expected performance comes from you can't see from CAPM, which is basically capital asset pricing model. There's a capital asset pricing model. So I can rub the rest. Okay, so we call it CAPM. This model was given by Markovich and then developed by Merton and Miller. And these economists, they won Nobel Prize in this model, CAPM. And the formula is very simple. The formula is Okay, I use the word Kone because Kone is the example, yeah? So I say that return of Kone, and I put a star here. Star means expected. Okay, so R, you call it asterisk? Asterisk. R star or asterisk is equal to expected return on Kone is RF. RF is risk-free rate. Risk-free rate is basically the 10 years bond rate in the country. And this remains for all the companies same, right? RF is the risk-free rate, which means that because when we are lending to the state, the probability of bankruptcy, well, the bankruptcy, even the state can become bankrupt. It is possible, but not probable, right? So the probability of state becoming bust is almost zero. And because of that, we call this as a risk-free rate. Now imagine, you can check on Kone, not Kone, you can check on Suomi Pankki's website. They provide the data of risk-free rate. I can show it later on, but for the time being, let's assume that it's 1% plus beta. Yeah, beta you have found already, yeah, haven't you? How much is this? Let's call it 0.91, or is it 0.9? 0.9. RM. RM is the market return. Can somebody tell me what is the market return in this data? Sorry? Can I call it 12.8%? Is market return 12.8%? Huh? Look, this is market return. I'm asking for market return. Yeah, annualized. We take annualized because the risk-free rate is not daily. You don't get 2% every day. It's for the full year. I mean, if it's a 1%, 2% is too much. Hendrika was telling that until last year it was 0%. So it's 12.8%. Let's call it 12.8 minus RF, which is again, let's call it 1%. If you use these numbers, you would be in a position to calculate the expected return from Kone, right? Does it make sense? So what we do here, let's calculate it. By the way, one addition to your vocabulary, the difference between RM and RF in simple words is also called risk premium. So if somebody used the word risk premium, it means that it is a difference between the market return and the risk-free rate. All right? Make sense? RM minus RF is called RM minus RF is called risk premium. All right? Okay, now let's do the calculation on the spreadsheet. We have expected return, Kone, and I can use a symbol that we find it by CAPM model so that we don't forget. Then we have 1%. Well, you either calculate everything with the coefficients or percentage, you decide, but don't mix them up, okay? So I go with the coefficients. Risk-free rate plus beta times bracket starts the market rate minus risk-free rate bracket closes. There we go. This is CAPM determined. This was expected from. So you can see here, we can have comparison. Compare the plus beta multiply RM, the market minus RM H5. So we just put all the numbers. All the numbers. This is the beauty of finance. You don't have to look for practicalities. You have the concept, you have the data, fit in, show it, simple. And what you get here is, whereas, let's call R only as actual return. And you know that actual return of Kone is 14.6. Is it so? And the expected return of Kone is 11.666. 11.66%. The difference is 692. So if I minus it, well, I can do it now. Here, actual return is this, minus expected return is this. There we go. This is your Jensen's alpha. This is 2.95 or 96%, which shows that the company has not only beaten the rest of the market, but the company has also beaten expectations attached to it. So this is, if you see in this one picture, in this one spreadsheet, you are comparing the company's performance with the risk-free rate, with the rest of the market, and with the expectations attached to itself. Right? And at the same time, you also learn how to calculate. Well, we did it a few times before also. You know how to calculate the systematic risk. So when all these numbers are attached, you can find Jensen's alpha. Jensen alpha is a very simple, straightforward tool, but at the same time, very, very in-depth. Theoretically, Jensen's alpha is super rich because it not only lets you to compare yourself with the rest of the market, but also lets you compare yourself with yourself. This is the company's actual performance. This is company's potential, theoretical, expected, notional. And the actuality is more than the potentiality. So you have over-realized, you have over-met expectations attached to you. So this is the beauty of Jensen's alpha. All right. So it's a good tool to remember. In the lecture slides, you will see, especially topic 1, you will see that all these conceptual things are discussed there. Okay. I was not so happy with the way I put my folders, right? But I have made some rearrangements, so now they're in the order topic 1, 2, 3, 4, and then if you go down, then you see these are topical things, and if you go down, Uh, at the bottom, you will find things about your thesis, some tips and ideas about how to do the review of literature and what type of research related things. But in the beginning, there are contents, the subject matter, and then at the bottom, you see the from more research point of view. Okay. Yeah, that's for this concept. And now we shall do some other concept, but after you, if you have any questions. Hmm? In Kone? Yeah. Remember, yeah. No, it's perfectly okay. If you see the if you keep the Anglo-Saxon countries out of the picture, when I say Anglo-Saxon, it means the USA and UK. In rest of the world, the family ownership is very, very deep down in the system. So it's a characteristic. Finnish companies, remember in Finland, we don't have the multinational companies. We are having the small and medium enterprises, right? And they are having a lot of involvement of the families. Look at the Italian companies, you'd be surprised. A company, even a public company, traded in Rome Stock Exchange, 60 to 70% shares are owned by the family. Only 10, 20% shares are in the stock market. You can't think about this thing in the USA. You know what? In the US, if your share ownership is touching 5%, you start getting notices from the state. Hey, why your shares are touching 5%? Because in the US, the system of ownership is very scattered, spreaded. I use the word diffused and dispersed, very fluid ownership. You can be having 4% shares in America, and you are the largest shareholder. Whereas in Europe, or especially in Italy, Germany, you can be 40%, 30% owner, and you still are not the biggest shareholder. Somebody has 35% more than you, right? In Europe or in Asia, the ownership is very condensed. Whereas in the Anglo-Saxon countries, the ownership is very scattered, especially in the US, even in UK, family ownerships are very, very deep into the system, but not in the US. Maybe the US companies are so big that even the family ownership are very big, but in percentage terms, they're small. Mm-hmm. If you are happy with this, I want to go a little bit further. I want to do everything now with Kone itself. Yeah. Now I want to find out total risk that Kone is facing. Beta is a measure of systematic risk. Yeah. Total risk is always equal to the total risk is always equal to the standard deviation of the company's stock return, right? So the standard deviation. Yeah. Can I ask you one conceptual thing before I go further? It's not a conceptual thing, it's more like a mathematical formulation thing. When I had the stock return of Kone and OMX, I annualized it, did I? But I didn't annualize beta. Is it an error or what? You see, when I have the Kone's daily return, I make it annual. I have the market daily return, I made it annual, but not to the beta. Any idea? If you look at the straight line, even if I take 1 day, if the gap is daily basis or a yearly basis or a monthly basis or a weekly basis, the slope of the straight line the slope of the line remains straight. It's not changing unless it's cyclical or curvature or something like that. But our assumption is that this line remains straight throughout. So it doesn't matter. You calculate on daily basis or weekly basis or monthly basis or full yearly basis, the slope would remain same. So even if I have this line, even if I extend this line here, or only for 1 week, the slope will not change. Since the slope doesn't change, there's no point of annualizing it. So the beta, the slope doesn't change. That's the whole idea. To clear it. Okay. Sorry. The total risk is the standard deviation of the stock return, right? So for example, we have two types of risk. We calculate total risk. Then we also calculate total systematic risk. And the difference between them would be equal to, I'm sorry. Sure. The difference between the total risk and total systematic risk is called what? Come on, what is risk comprising of? Which two types of risk? Sorry? So therefore, if you have total risk minus total systematic risk, what is left then? There you go. So that is the total unsystematic risk. All right. Now, total daily risk is again we shall be doing it on first on daily basis, and then we will annualize it. Okay. It's very simple. Very simple. Please have a look what I am doing here. Your company stock return column was C column, I guess, yeah? C2 to C1524. So what we do here is equal to standard deviation. Can you see here STDEV? Yeah, that's standard deviation. And if I select the data C2, I don't have to select it. I can simply type it 1524. This is total daily risk, right? Samriti is fine. And once again, I can use the previous formula to make annual, because if I have the return annual, then why not risk annual? You know, you can't compare annual return with the daily risk. It has to be equal unit. So we say total annualized risk. And what was the formula? The formula was very simple, is equal to bracket starts 1 plus the number itself, bracket closes, to the power of 250 minus 1. Here we are. Altogether, the total risk faced by the company is this much. Okay. Yeah. So it's exponential to the power of 250. Yeah. This is total risk. And then remember, you have systematic risk yet, but not total systematic risk. So the total systematic risk is, I can write the formula. But before you go to that stage, you find the total daily market risk. I want to save it, so I can save it on desktop, but I would be sharing it with, not here, maybe. Kone. Since I'm doing everything in one sheet, so I can call comprehensive calculations, so that you don't have to see many sheets, but most of the things you can get from one spreadsheet only. Right. So the total market risk, can somebody tell me which column is the market risk? Well, it's E. I just wanted to wake you up. So is equal to standard deviation. This one here. And this should be E2 to E1524. And then we can also find the total annualized market risk. Total systematic. Now here, you have to be very careful. Total systematic risk, I'm putting a note here so that you remember, equals beta times annualized market risk. So what we do here is, but we haven't analyzed it yet, but let's analyze it first. So we bracket this plus 1 to the power of 250 minus 1. This is the total annualized market risk. And if I multiply beta with this, that would give me the total systematic risk. So you can say that the company's total risk is 37%, and the company's total systematic risk is 14.21%. Therefore, the difference between the two the risk which comes within the company, the homegrown risk is the total risk minus the total systematic risk. There you go. I can safely say that almost 60-70% risk is coming from within the company, only 30 to 40%, depending upon, you can find the percentages if you want. If you want, we can find the percentage. For example, if I divide this by total, or if I divide just by total. And if I show them in percentage terms, as a percentage, you can say that 39% risk of the company is coming from outside, whereas 61% risk is coming within the company. So the homegrown risk is more than the externally imposed risk. This is a kind of one-stop shop spreadsheet. You did risk, return, their types, their categories, and their comparison and distinction. And also on top of that, you learned how to compare a company's performance with the market and with itself, right? So this is what I wanted that you should learn today. Next week, when you people come, I would not teach concept on slides you do by yourself. But I would take one example. Maybe I can Kone. Maybe the same spreadsheet I continue. And I would be discussing what Amaya asked me. What the Altman Z score means. How probable is that Kone would become bankrupt? Okay. So we are doing reverse. We are going from practical to the theoretical. Because many of you have done these concepts. Not all of you, but many of you. I don't want to go by slide. I would rather do by spreadsheet method. Okay. So that's everything for today. I thought it would take a long time, but maybe it did. Yeah. So thank you very much for attending Hendrika's session, right? And since I'm recording it, everything I would be sharing with you. All right. Thank you very much. See you next week. We will go. I'll get you the